Total quarterly revenue hit $28.2 billion, which is a massive 26% year-over-year jump, but operating margins shrank down to a razor-thin 1.4%.
Right, and their free cash flow swung from a positive $1.4 billion a year ago to a negative $1.1 billion today.
And if you look at the management commentary, they're explicitly guiding that scaling will be nonlinear going forward.
Yeah, so we're seeing a massive top-line revenue beat, but a pretty brutal bottom-line miss.
Exactly. So let's just jump right into it. Welcome to this deep dive. For those of you listening, whether you're, a retail investor, a tech enthusiast, or just someone who follows the auto industry, we have a monster of a document today.
We really do. It's the official 36-page Q2 2026 financial and operational summary deck released by Tesla.
Right. And our mission today is pretty straightforward, but it's not easy. We need to bridge the gap. We want to connect Tesla's headline-grabbing sci-fi ambitions, things like unsupervised robotaxis and bipedal humanoid robots, to the cold, hard financial realities of how they're actually paying for all of this right now.
Because it is a fascinating case study. I mean, you are watching a company attempting a massive high-stakes identity pivot in real time. It's the ultimate corporate pivot, honestly.
It really is. And if you want to understand Tesla today, you kind of have to look past the cars. You have to follow the cash flow into infrastructure and AI, which brings us to our first major theme for this deep dive.
The $100 billion milestone versus the margin squeeze?
Yes, exactly. Let's start with those top-line numbers we hit on at the opening because they really are staggering. For the first time ever, on a trailing 12-month basis, so looking at the last 365 days, Tesla crossed $100 billion in total revenue.
Which is just a massive psychological and financial milestone.
Absolutely. And in just Q2 alone, they hit that $28.2 billion. Plus, they delivered over 480,000 vehicles, which is up 25% year over year.
Right, and they're seeing record deliveries in places like South Korea, Australia, Colombia, Portugal, and they even launched the new Model YL in the US, which definitely helped drive some of that volume.
Yeah, so if you just read the headlines, it looks like a total victory lap. But then you flip the page and look down the income statement.
And that's where the victory lap turns into a really steep uphill climb.
Very steep. Income from operations. The actual profit from running the core business plummeted 57% year over year. It's down to just $398 million. And like we said, that operating margin shrank by almost 270 basis points to just 1.4%.
And the free cash flow went negative, negative $1.1 billion. It's honestly a massive financial whiplash in a single report.
Okay, but I have to stop you there and push back a little. Because 1.4%, I mean, you could literally make a better profit margin running a local grocery store.
Oh, absolutely. Yeah.
Or like a legacy commercial airline during a bad year.
Yeah.
So for everyone listening, how does a company that's valued like a tech darling end up with the margins of a discount supermarket? Like, is this just them slumming it temporarily while they build something else? Or is this the harsh reality of heavy manufacturing finally catching up?
That is the exact question Wall Street is wrestling with right now. To understand the 1.4%, you have to look at the mechanics behind the squeeze. It is a convergence of a few massive pressures.
Okay, lay them out for us.
First, on the vehicle side, the average selling price, the ASP, is lower. They are cutting prices to move volume, and that's even when you exclude the negative impacts of foreign exchange rates.
So they're just flat out making less money on every piece of metal they sell.
Correct. But then you also have to factor in the drop in regulatory credit revenue.
Oh, right. The emissions credits.
Exactly. Historically, they've made hundreds of millions selling those credits to legacy automakers. It's basically 100% pure profit padding their margins. But this quarter, that dropped to just $146 million.
Wait, down from what?
Down from over $400 million a year ago. Legacy auto is catching up, so that free money is drying up.
Okay, so cheaper cars and fewer credits. But that can't be the whole story, right?
Yeah. No, the second part, and arguably the bigger factor, is on the expense side. Operating expenses exploded by 47% year over year, hitting over $4.3 billion.
Wow. $4.3 billion in operating expenses.
Yeah, because they are pouring an unprecedented amount of cash into R&D, specifically for AI projects. Add a sudden hit, they took on energy warranty-related charges because of a vendor's battery issue, and you have a perfect storm.
Shrinking margins on the cars, combined with skyrocketing expenses for future tech.
Exactly. That is your recipe for a 1.4% margin.
Okay, mathematically that makes sense. But seeing negative $1.1 billion in free cash flow, That sounds terrifying. It sounds like a company bleeding out,
It does, until you see where the cash is going. They aren't burning it on unsold cars sitting in a lot. We know this because global vehicle inventory dropped to just 15 days of supply.
which is super lean.
Incredibly lean. That cash is going directly into the dirt. They had a sequential increase in capital expenditures, CapEx, of $3.3 billion just between Q1 and Q2.
So it's an intentional leak. They're funneling it into this massive spending spree, which brings us to our second theme. Management calls it their investment in amazing abundance.
Which is very Silicon Valley.
Right, very Silicon Valley speak. But let's call it what it is, a CapEx explosion. Capital expenditures hit a staggering $5.78 billion this quarter. That's a 142% increase from last year. Where is almost $6 billion going in 3 months?
It's going into physical, concrete, and steel infrastructure. Two main buckets, really AI compute and energy. On the AI side, they've more than doubled their on-site compute in Texas just in the first half of 2026.
By building data centers, right?
Massive ones. The report details Cortex-1 pushing over 90 megawatts and Cortex-2 demanding over 115 megawatts of power.
Let's contextualize that for you guys listening. When we say megawatts, we are not talking about a big server rack in a closet. A single megawatt can power hundreds of homes, so a 115 megawatt data center, that requires the electricity grid of a mid-sized city.
And they are building two of them, just in Texas. And Cortex-2 is specifically for training the neural nets for both the vehicles and the humanoid robot.
Okay, but here's where it gets wild. They aren't just building data centers and buying NVIDIA chips. The deck says they're actively building their own semiconductor fab in Austin.
A physical fabrication plant, yes, to make their own logic and memory chips.
Okay, I have to jump in with a major pushback here. Writing code is one thing. Building a semiconductor fab is entirely different. Those are notoriously some of the most complex, difficult-to-build facilities on Earth.
Oh, without a doubt.
Clean rooms, ultra-pure water, billions of dollars just to break ground. It's like Apple saying, we don't just want to design the iPhone, we want to own the lithium mine and pour the concrete for the server farms. Does taking on this much real-world friction risk distracting them from their core consumer products?
It is a huge operational risk fraught with delays and permit issues, but management's counterargument is that this infrastructure isn't a distraction, it's the central nervous system. They want to vertically integrate the entire AI stack.
So they write the software, design the chips, manufacture the chips, build the data centers, and power them with their own solar and batteries. Using
lithium, they refine themselves, which transitions us perfectly into that second bucket, the energy and battery infrastructure. Energy storage deployed 13.5 gigawatt hours this quarter.
Up 41% year over year. And again, 13.5 gigawatt hours is an unfathomable amount of energy. That stabilizes the power grid of entire regions.
Exactly. The megafactory in Shanghai is ramping up. Texas is nearing completion, and they're ramping up in-house battery-grade lithium refining in Texas, plus launching the Powerwall 3P in Germany.
It's like they're quietly becoming a global utility company hidden inside an automaker.
Precisely. They want to own the concrete, the lithium, and the chips to guarantee they can scale the brain for their most important software product, which is finally hitting the streets.
Which brings us to Section 3, the autonomous leap. Going from the screen to the street. Let's look at the full self-driving, or FSD, and robotaxi metrics, because they are wild.
They really are.
They now have 1.48 million active FSD subscriptions, a 56% jump from last year. Almost 1.5 million people paying a monthly fee to let their car drive them. And in North America, over 55% of all new deliveries include an FSD subscription.
And for anyone listening, that 55% attach rate is the most important number in this entire document, because remember that brutal 1.4% margin we talked about.
It's a grocery store margin.
Exactly. The antidote to a 1.4% hardware margin is a highly profitable software subscription. When someone clicks a button and pays $100 a month for FSD, the margin on that is incredible.
Right, because it costs them virtually nothing to digitally flip that switch.
They are desperately trying to shift the profit engine away from the metal box and toward the software inside it.
And they're doing some serious software gymnastics to make that happen. They're rolling out FSD version 14 Elite to HW3 vehicles.
Right, the older hardware 3 chips.
Yeah, so millions of older Teslas on the road. They are taking their newest AI brain, AI4, distilling its behavior and forcing it to run on older computers. It's like trying to run a brand new PS5 game on a PS4.
They have to squeeze every drop of compute out of the legacy fleet because that fleet is their data engine. But it's not just supervised FSD anymore. The robotaxi's on the street.
Yeah, they officially confirmed unsupervised rides launched in Miami, Orlando, and Tampa in July.
And the Cybercab, the purpose-built autonomous vehicle with no steering wheel, is in production at Gigafactory, Texas. Employees are already taking test rides on campus.
Okay, I get the vision, but let me push back on this rollout strategy. Employee rides on a closed Texas campus. That makes perfect sense, but completely unsupervised public robotaxi rides in 3 major Florida cities.
It's aggressive.
Very. Wouldn't it make infinitely more sense to prove flawless execution in one single hyper-controlled environment before deploying into chaotic Florida traffic?
If you look at traditional autonomous companies, yes, that's what they do. They use LiDAR in geofenced areas. It's like driving on invisible digital train tracks. But Tesla uses pure vision. The car learns to drive using only cameras, just like a human eye and brain.
So no invisible train tracks. They are reacting in real time.
Exactly. And to train a generalized AI to react anywhere, you actually need the chaos. That's why those 1.48 million subscribers matter. They need the edge cases. A sudden Miami thunderstorm, tourists in Orlando.
The weird pedestrian traffic in Tampa.
Right. Every time a human driver corrects mistake, that video feeds back into those massive Cortex data centers we talked about. It teaches the hive mind. Restricting the geography, it restricts the AI's learning rate.
So the chaos is actually a feature, not a bug.
Precisely. And they want to make this AI even more integrated into daily life. The report highlights the summer release, integrating Grok, their large language model, directly into the car.
So it's not just steering anymore. You make phone calls, search for music, adjust the climate control just by talking to it normally.
They want the experience to be social and interactive, a personalized assistant on wheels.
It's an amazing vision. But here is the craziest part of this entire deep dive. They are taking this exact same AI brain that learned to drive in Miami and putting it into a completely different form factor. And to do it, they are making some ruthless decisions about their legacy products.
Which brings us to the final section, burning the ships.
Yes, this is arguably the most dramatic, symbolic detail in the whole 36 pages. Let's go back to that Fremont factory floor. Tesla has officially decommissioned the legacy Model S and Model X manufacturing lines.
It's wild to even think about.
These are the flagship luxury cars. The Model S proved an EV could be fast, sexy, and a status symbol. It built the modern Tesla brand, and they physically ripped those lines out of the ground to install the first-generation production lines for Optimus.
The humanoid robot. It is a profound psychological and operational shift, giving prime manufacturing real estate to bipedal robots. The deck states these initial builds are for the Optimus Academy to collect training data.
Wait, Optimus Academy?
Yeah. So those Cortex data centers in Texas, they aren't just processing driving videos anymore. They are processing video of robots walking, grasping objects, doing physical labor. The robot uses the exact same visual neural net architecture as the cars.
So the car is just a robot on 4 wheels, and Optimus is a robot on 2 legs.
Exactly.
But ripping out the Model S and X lines, that is a modern corporate version of burning the ships. It's the ultimate no-turning-back move. You don't tear down the lines for your $80,000 luxury sedans unless you are unequivocally convinced humanoid robotics is the future of the economy.
Right, there is no plan B here.
But here's my biggest question for you. While they are burning the ships on legacy cars and burning billions in cash on data centers and chip fabs, what is keeping them from sinking today? Because a 1.4% auto margin isn't paying for a semiconductor plant.
No, it's not. That's where you have to look at the quiet, unglamorous powerhouse of this quarter. It's a segment called Services and Other. While auto margins were getting crushed, services revenue surged 50% year over year to $4.58 billion. And they achieved a record gross profit there of $648 million at a 14% margin.
Let me be sure I heard that right. A 14% margin on services compared to a 1.4% operating margin overall.
It is a completely different business model.
But is a 14% margin on car servicing, changing tires, fixing windshields, is that really a big enough life raft to keep this massive operation afloat while we wait for Optimus to get a job?
It actually is. Because of the unavoidable math of their fleet size, Tesla's cumulative deliveries are approaching 10 million all time. When you have 10 million cars on the road, they all eventually need tires, collision repair, out-of-warranty service.
And they all need to charge.
Crucially, yes,
Yeah.
the supercharger network grew by 17% to over 8,700 stations globally. This installed base of 10 million vehicles creates an incredible annuity of service revenue.
So if you own a Tesla, you're locked into that ecosystem.
Exactly. It's the unsexy, cash-generating life raft that affords management the luxury of making these massive, world-changing bets on robots and chip fabs.
Okay, let's bring this all together for everyone listening, because we have covered an immense amount of ground. If you look at this Q2 2026 report, Tesla is generating over $100 billion a year in revenue.
But spending it almost as fast as they make it.
Right. The traditional auto business, stamping metal boxes and selling them, is facing severe margin compression, down to a 1.4% margin. But they are willingly taking that pain to fund the largest physical investment period in their history. Billions into AI compute, in-house chip manufacturing, global energy storage, and tearing down legacy lines to build bipedal robots.
And that transition is the defining narrative here. They are trying to cross the chasm from a heavy manufacturing car company subject to interest rates to a high-margin, generalized AI platform. The services and energy segments are just keeping the lights on while they attempt the leap.
Which brings me to a final provocative thought for you to mull over as you go about your day. Management stated in this report, scaling will be nonlinear and future profits will be software and fleet-based. If that vision actually comes true, and the AI brain is the real product, while the car is just a vessel, at what point does the market stop evaluating Tesla on how many metal cars it delivers and start demanding the financial metrics of a software platform?
That's the billion-dollar question.
Could the physical car eventually become nothing more than a zero-margin loss leader? Imagine a world where the car is sold at cost, just to get you hooked into their high-margin AI subscription ecosystem. It completely changes how we define what a car company even is.
It is the ultimate pivot, and Q2 2026 shows they are fully committed to it, regardless of the near-term margin pain.
It's a completely new reality. Well, thanks for joining us on this deep dive. Make sure to follow the show for our daily earnings coverage, where we take these massive reports and break down exactly what the numbers mean for you. Until next time.